Trader's Corner, Doc.
Hey, thank you very much, Rob. I'm assuming you can see my screen and you can hear me okay.
I've got it loud and clear and visually acceptable.
Okay, so fantastic. Thank you very much, and I appreciate being invited back here onto Trader's Corner. Okay, I'm going to give you guys a quick visual. This is kind of the follow the bouncing ball that I always go through, so you get a sense of where I am in the presentation. This is only going to be, 40 minutes or so by the time we finish up, so I'm going to keep everything on time, and hopefully I'll keep your attention with this so you know where I'm at in the presentation. So who am I? Who is Doc Severson? Well, I'm an individual trader and performance coach since 2005. 2005 was when I put in my notice I was making six figures at a three-letter acronym telecommunications company, and I was miserable. So I know the feeling if you guys are working a career that you're not necessarily excited about, or you feel like you're just cranking the wheel every single day, but there's this trading thing going on out there, and it's like you see this as potentially your salvation. I certainly did the same thing. I was torn by desperation to get out of there and inspiration to go into the trading field. So I finally put in my notice and I burned the bridge and jumped into this. And then what I found was within a couple of months, everybody started knocking on my door saying, "Hey, dude, you quit your job. How'd you do that? Could you teach me too?" And what I found was it was great because when you trade for a living, all of a sudden, and many of you found this out during the pandemic, like working from home is pretty isolating. There's no lunch crowd that you're meeting with anymore. There's no office chatter. There's no, sports books going on. So it was just me and the dog. And it was great to start working with people and helping other people. So I've been doing that since 2005. You may have heard of me through either Options Linebacker, Options MD, Theo Trade, Doc's Trading Tools, ReadySet.Trade, several services that I've been part of. Love to help people. My specialties are fractal price analysis, which is written up in this book that's over here. So Fractal Energy Trading, which is available on Amazon.com, as well as the trading mindset. And I understood how important this is. So I wrote a book on Amazon as well too, Hacking the Holy Grail, because I had to fix my own brain and my own thought processes before I could become profitable as well. And it was such an, awareness. It was such an exciting discovery for that I had to share it with everybody else. So what I like to do is simplify the complex, and that's what I'm going to be doing for you guys today. So my purpose is really on behalf of the smaller investor. So many investors are discovering trading these days in very perilous markets. We've had just a huge influx since the pandemic from people saying, "Hey, I want a piece of that." So I want to see today's small investor learn to win without getting stepped on, without thinking that they have to join some wild subreddit like Wall Street Bets in order to win. We'll do exactly the opposite of that. So there's also something very compelling about the natural edges inherent in option selling that I want to share with you guys, especially with these new zero-day options released last year. So my purpose today is to make you aware of them, show you some setups, and in general, help you decide if this is something for you. And if you got 40 minutes, I'm going to walk you step by step on how to start creating income with a simple trading strategy that puts the odds in your favor, one you can start using on Monday. Okay, so here we go. We're talked about why we're here. Everyone is trying to set themselves up for financial freedom. But the problem is that we've all been taught through media on the old ways. Using yesterday's methods just won't work anymore. The old paradigm of investing was to continue to grow your pile of assets. And then once you've accumulated enough, you could safely live off the interest without depleting your principal. So the old standard was to build up $1 million and then live off of $50K a year in interest at 5% APR. Nice dream, but the problem is, even with today's inflation, where we're, 7% inflation year by year, we're still only paying 3.4%, 3.7% on savings accounts. And that's if you, basically surrender your soul to do something like that. 3.4% a year is just not going to cut it, and it's not going to keep up with inflation. So there are a lot of current alternatives to interest income that a lot of you have heard about, like annuities. The problem with those is they lock you in for years to receive a small return. Nobody likes them. Bond yields are still low. Stock dividends can be upwards of 7%, but you're going to pay for it by getting a lousy chart that doesn't do any capital appreciation. So to me, the traditional methods of augmenting returns are terrible in today's market, and they have been lousy for a long time. So this means that you can follow the old paradigm of growing your pile of assets, but the goal of being able to make money on your money is no longer there if you use those old techniques like annuities, dividends, interest, things like that. The problem here is the retirees are going to be shredding through their principal in no time and wondering what changed, even though this has been happening for the past 2 decades. So there's so many lines that I can steal out of the movie Aliens, but probably the best one for this is by Private Hudson, who's always whining about something. What do we do now, man? Game over. Well, I don't think so. I don't think it's game over. I think we just need a different perspective on things. We need to create income in different ways. So are there different forms of passive and active income that can work to replace the old vehicles like annuities, interest, and bonds? Yes, there is passive income, which is earned without active participation. So this is like the holy grail. Everybody talks about passive income. So setting up an Amazon store that runs without you, right? Good luck doing that, right? But those are typically what you find with interest and dividends. Or there's active income, which does require your participation and effort to earn income. A typical example with that would be like a job or active trading. Now, can we do this with stocks? Can we trade income or stocks for income? Well, they're still pretty expensive even after the bear. It requires a massive amount of capital to trade market leaders. Day trading stocks requires too much capital for smaller accounts. The pattern day trader rule is very restrictive and will crush you unless you've got at least 25 grand to work with. So to me, trading stocks for income, not very efficient, not going to cut it. So to me, options are the answer. Hopefully you guys have heard of options before. We don't have time in 40 minutes to discover, like what options are. But I would say everybody has used them before. If you've ever bought an insurance policy, you've bought a put option. If you've ever bought a coupon for something, you've bought a call option. So passive income, we can sell longer term options to act like an insurance company where we're collecting the risk premium from option buyers. We're just taking a little bit of, we're acting just like an insurance company, exactly like that. Or active income, we can look for short-term opportunities to either buy or sell options using the leverage of options to more efficiently use our capital. So to me, options are a perfect vehicle for creating income. It's almost what they were made for. So my assumption for today, again, based on the time that we have too, but this is an advanced trading webinar. When we get into Traders Corner, this is typically people that know what they're doing. I'm going to skip the usual background and options, get right to the strategies. So again, I intend to give you everything that you need to know by the end of my presentation so you could get started trading this on Monday. How do we generate active income using weekly options? Now, I want to set the stage for something here. I want to set expectations for those of you in the retail world. The next section is called Earning $100 a Day. Before I lose you, let me explain. Earning $100 a day doesn't sound like much of a goal to most people. And usually around the time I put this slide up, people are like, hey, that's not going to cut it. I'm making more than that on my job right now, et cetera, right? I understand that. And especially in this business where people are promoting, hey, we made $5,000 in our trading room yesterday, and we made $10,000 before that. And it's like an arms race to see who can promote who made the most money yesterday, right? But that doesn't really help the average retail trader who doesn't have the courage to do something like that, nor the risk appetite for that. So earning $100 a day doesn't sound like much of a goal, but you have made significantly more than that in your job, but you've got to start somewhere. And this is why I'm saying you got to start somewhere, even if it's $100 a day, even if it's $10 a day. Most retail traders that I work with would give their left arm just to achieve consistency, to start somewhere with consistency. So pick one thing, start with a modest goal, continue to improve on it every day. This is the key to success over time. This is really the holy grail of trading, is to pick one thing and continue to get better at it. Where I see most people running into problems is they buy a package or a program, they trade it a couple of times, they don't make any money immediately on it. So there's a bright, shiny penny over here, which promises all kinds of wealth with no effort. So they trade that a couple of times. That doesn't work out. So this is what I see for most retail traders. They're just running around, instead of getting 10 years of experience, they get 6 months of experience 20 times, and usually end up right back to where they started all over again, maybe a year or two later, and saying, okay, maybe now I'm ready to get started. So what I want you to do is to be honest with yourself. Pick a modest goal, pick something that you're fascinated by. Now, one thing I love is this notion of the power of tiny gains. If I were to challenge you in person, if I met you and you would say, hey, I want to get better at what I'm doing. And I would say, hey, can you get 1% better at your strategy? Can you go home and work at this strategy, get 1% better between today and tomorrow? And I think 100% of people would say, yes, I can do that. I can get 1% better. Okay, so the next day you come back and you say, I definitely got at least 1% better at my strategy. I would say, great, now do it again today. And then again the next day and the next day. If you take something from whatever starting point and if you get 1% better every day at something, by the end of the year, you'll be almost 38 times better at that. Just with these little tiny gains, this is called the aggregation of marginal gains. Now, if you do the opposite, this is what a lot of people do. They get 1% worse every day because they don't work at it. You'll eventually revert back to zero. So it's your choice. But it all starts with doing one thing, start with a modest goal, and continue to refine it every single day. You don't have to have the world's most complex strategy. You can do very simple things and get better at it every single day. Now, we use an income pyramid-based approach here. We do a lot of our, the big, heavy, slow strategies that are almost like the foundation of a house. You can't even see it. It's not something you can see from the curb, right? You pull up to a house and you don't look at the foundation. First of all, these are things that are kind of subterranean down there, just kind of chugging away, maybe months at a time. What we're talking about here today with active income is going to be more up in the upper end of the pyramid. So we're going to be using way less capital with strategies like this if we're going for active income. Now, your approach is going to be different from everybody else's. So everybody comes to this venture with a different amount of capital, different amount of time available that you can spend on this, and certainly different levels of knowledge. And then we get some kind of Venn diagram here with an intersection of all three of them. What I hear from most people is, well, I can't be successful because I don't have enough capital, or I don't have enough time. And certainly those can be constraining factors for this, but I will tell you, give me somebody with small amount of capital, with not much time, but willing to work in a very specific segment of time and understands that there's no limit on the amount of knowledge that they can add. Give me that person every time. That person will be successful. What you find is it really doesn't matter how much capital that you have. It doesn't really matter if you have all day. You don't really need all day. All you need is just a few minutes. And this is why we call this business 12-minute trading. We just need a few minutes every day to be able to execute on our strategies because we do simple things. So this intersection, again, does not really matter how much capital that you have, does not matter if you've got just a few minutes, but if you can add an infinite amount of knowledge or there's no limit to the amount of knowledge that you can add to this, then you can start to leverage capital. You can start to leverage your time, and you can find the perfect intersection between the three. So everybody's got a different combination, but there's really one very simple way to manage this. So certainly it's easier with larger accounts. We could play passive income, but it hasn't been that easy for the past year, no matter how good your stock is. So today's focus through the rest of the next half hour here is going to be active income using weekly options. So let's talk about zero-day options for a second. Weekly options were released about 15 years ago. I remember this was a big deal when they first came out, because they came out on these massive stocks, and all of a sudden, instead of just these monthly options, we also had ones that expired on Friday. So what we find now is the bigger equities have these weekly options, but if we go to the S&P 500 now, as of last year, we now have 5 days a week. And it's probably not going to be too long before we have intraday options, but that's a whole nother discussion. So we have these zero-day options. Every single day, we have an option which is expiring. Okay, we have this on the NDX, which is the NASDAQ 100. We have this on the S&P futures options as well, too. And now we have them on the spiders and the Qs. And the IWM and the diamonds offer different forms of that. IWM offers 3 times a week. The diamonds for the Dow offers normal weeklies on Fridays. So we certainly can trade with smaller accounts, the spiders and the Qs, with zero-day options. And imagine this, you're walking across the room with an ice cube. You're holding an ice cube in your hand, and there's a certain amount of passive melt, which is going to happen, but you're walking towards this blazing fire on the other side of the room. Well, the heat detected is going to vary with the square of the distance. So the closer that you get, the faster that ice cube is going to melt. And it's just like into the end of the day, this is very, very fast. And imagine that with an option living its last day. So this is what happens with these zero-day options. They melt very, very quickly. Now, again, these are very sharp instruments. These are not really the place to learn your first option trade. So I would start with something much, much slower, kind of like those batting cages when you were learning to play baseball. You didn't step into the 80-mile-an-hour cage on day one when you got your brand new baseball bat, right? Start out with a 40-mile-an-hour, see if you can hit something a little bit slower and work your way up in speed. Let's talk about neutral strategies for a second. These are where we're acting as the insurance company. Now, the great thing about this is for a long directional trade, you're either going to see the price go up, down, or sideways. The problem here is that with a directional trade, you're only looking at about a 33% chance of winning on an event basis, right? So if the price goes sideways, that's opportunity cost. That doesn't count as a win. For a neutral options trade, let's say we're doing a bullish neutral option trade, you're either going to see the price go up, sideways, or down. In this case, if it goes sideways, we win. This equates to a 67% chance of winning, since an asset trading sideways wins with that wasting asset. Remember, we're an insurance company. We're the house in this case. So to me, 67% is better than 33%. And what I found with most retail traders is we want wins. We want to win. We want to feel that confidence that we want to put a trade on that we've got a better than even chance of winning that trade. It's extremely important to try to build confidence. So some neutral strategies, I'm going to go through these very quickly. The short straddle is the king of option selling strategies used by professionals, but the main problem is the huge margin required due to the unlimited risk profile. Lots of war stories out there from new traders getting blown out due to unlimited risk curves. For some reason, it seems to be airline pilots are the most affected by the short strangle. Don't know why. So what we do is we cap the risk and we create what's called the iron condor. This is a high probability. That's what the HP means. High probability iron condor. For this style of condor, probabilities increase by using a lower reward to risk. And then we can also do the low probability iron condor, where we're setting the reward to risk to 1-to-1. For this style of iron condor, probabilities decreased using higher reward to risk. It's not better or worse, it's just different. We can also use the iron butterfly. Width, in this case, is sacrificed with speed in this trade. So it's much, much faster trade. You don't need to learn 42 different fancy sounding option strategies. You don't need to use all kinds of crazy studies on your charts and things like that. Just a handful of properly applied, correctly managed strategies will work to create consistent income. So I'm here to tell you guys, don't make it harder on yourself. Keep it simple. You're following an insurance company business model by taking risk out of the market. You're being paid for it by those that want to offload their risk. So this is how we're going to earn that daily income. So let's talk about analysis techniques for a minute. Now, there's two kind of religions that are out there in the retail world. You may have seen or heard of these before. I'm going to kind of walk through this just for a second. There's two schools of thought, and both of these disparage each other. So random walk is basically practiced by those that are in Chicago. There's something in the water there. Anybody that grows up trading in Chicago or works in an institutional firm is basically going to be trading options through random walk. Implies that there is zero knowledge about forward price action. Forward price movement fits into a log normal distribution of price. Okay, fair enough. Technical analysis started because people were not in the trading pits, did not have that advantage to see and feel and even smell price discovery. So we've all had to do this on our own out there in the world, understanding what price discovery is through charts. So technical analysis implies that we can project forward price movement based on past behavior. I have a little bit of an argument with that. That's not the way I use it, but that's what a lot of people feel. So these two schools of thought are at religious extremes with neither side respecting. So what I think that we do is we use both of them. Why not? So random walk, we can use the expected move to find a 1 plus or minus 1 standard deviation distance. We can use option delta to find probability of success. We want to place positions outside of this expected move to increase our probability that we're going to win the trade. And we want to target positions at specific deltas so we get repetitive results. So here's how we would do something like this. We're going to pull up to the option chain, and this is going to be for the 3rd of March. And we're going to see through Thinkorswim that we have a 77-point expected move. And we're going to take this current price and we're going to add and subtract this expected move to that and make sure that we're going to place our trades outside of that. So if we're going to place put spreads, we want to be well below 38.92. In this case, we're selling at 37.80. So we're selling more than 100 points below that lower expected move. So this gives us a 68.2% probability envelope of success, or we can increase that by going further out. Okay, so we're stacking probabilities based on our analysis with this. Now, technical analysis, our goal is not to predict the future with TA. Many try to do this. I think it's a fool's errand. We use TA to augment the statistical analysis of random walk. So what is our goal with these neutral option selling strategies? It's to enter and exit when there's an absence of a linear trend. So markets don't move like this, right? So think about if you were going to summit a mountain, you're not going to just sprint all the way up here and summit, 45 minutes later. You're going to go as far as you can. You're going to rest. You're going to go as far as you can. Again, second push, you're going to maybe have lunch, get your wind, and then maybe you'll have a final push. This is how markets work. This is how they operate. They trend, they consolidate, they trend again, they consolidate, whether it's to the upside or to the downside. So what we're trying to avoid is periods like this where the price is on the move. we're trying to catch the price in a consolidation. So this is where we can use some of our technical tools. And this is where I use what I call fractal energy. Now, I don't have time to explain this. It's in the book, right? But to me, markets don't go into overbought and oversold conditions like the way we were taught 50 years ago. So markets just operate differently today. So to me, it's all range expansion, range contraction, and it works over and over again. So looking at, this is actually called the choppiness index, which is not available in Thinkorswim. It's available in certain packages like TradingView and TrendSpiders, things like that. That's called a choppiness index. And you can also think of this as like a fuel gauge for the market. Fuel or full and empty, full and empty. So when we have markets that are just chopping around, they're actually building up a tremendous amount of potential energy, which comes out in the form of a trend into exhaustion. And then they build up energy again, and then they get ready to trend again. These are high energy conditions here where we have a full tank likely to trend. This is where we avoid them. And then the opposite side of that, or the converse, is exhaustion, where a market has been trending for quite a while, or it's in a very straight linear trend, and this is exhaustion. This is where we hit it really, really hard. And so we improve our probability of success by doing this. Okay, so we're going to initiate a range-bound options offense when conditions appear likely, and we're going to take care of avoid trading before these big economic announcements, things like that. We place positions outside of the expected move. We set specific probabilities. We're very meticulous about how we do things. Now, this is something that's also very important down at the very bottom here. I don't want to lose this point. There's 252 trading days a year. You don't have to enter every single day. This is not a casino. Some people treat it like a casino. You don't have to do it that way. The house always wins in a case like that, or the broker does. So now let's talk about defense, the other side of things. And we're getting close. We're getting closer. We're going to come in on time here. So stick with me another 15 minutes. When we place an option position for a credit, we're essentially kicking off the ball to the market, and then we're sitting back and playing defense, protecting the goal line. So to me, this is like a perfect analog football to how an option trade is placed. And the way I defend these is through two different ways, static and active. A static defense is one that's set up ahead of time before the trade is entered. A lot of people don't do this, right? This is actually called a stop, right? An active defense is one that's played during the duration of the trade. This is maybe where you're adjusting deltas or you're adjusting portfolio risk, things like that. The defense necessary for an iron condor is going to depend on the structure of the trade to begin with. So an iron condor, which is a low probability one, this one is set up with the right risk. So the risk equals the reward on this particular trade. This is 1-to-1. And what I love about this is the structure of the trade becomes the static defense of this. In a trade like this, I don't have to worry about some kind of black swan event or anything like that, where all of a sudden Jerome Powell wakes up in the middle of the night and says, I'm going to go 500 basis points for my next rate hike, which could happen. You just never know. Now, with a high probability condor, this is the way a lot of retail traders start out, because they're saying, well, these are better because they're higher probability. They're not better or worse or anything. It's just a different structure. The area under the curve is the same thing as a low probability condor. I just think most people start out with these and eventually they migrate towards the lower probability trades because the reward to risk is much better. Now, we can also use a static defense. We can close at defined point distance threshold. We can do things like that. So we can say, hey, if it gets within 50 points, things like that, we can set that up. I don't like that because it adds too much variability to it. But some people like to start off like this with a static defense. We can also close a defined delta of short strikes. So if I start out with a trade with a 5 delta, if it gets up to a 20 delta, maybe it's time to close the trade or roll it or adjust it in some manner. And then the third way of doing static defense is close a defined exit debit, which is a lot more precise. It's a little bit harder to do, but it's much more precise in terms of your final result. Understand that there is no perfect static defense. One that is too risk averse will suffer from early exits on trades that would have worked out fine, right? So if you ditch your trade at the very first, red candle that starts to go against your position, you may find that that's just an intraday move. One that's too aggressive will allow holding through deep attacks, but legitimate exits will be expensive. Find one that works best for you. Stick with it. Don't move around. An active defense requires much more skill and judgment to employ. So it sounds cool to employ active delta neutral hedging strategies, but there's a very good chance that a poor application will actually increase losses and turn winning trades into losers. One of the worst examples that I hear of is people that are doing like this with vertical spreads. A vertical spread has a short option and a long option. In this case, I'm looking at like a call spread. And as the price comes towards this, what some people are teaching is, well, what you do is you shut down your short option, just buy that one back and let the long option run, which is probably some of the worst advice I've ever heard, because nobody's going to be able to provide any kind of, it's not going to work out long term, because there's no way that you're going to be, there's too much variance in something like that. So active defense, the traditional problem with an iron condor is setting up the trade and having the price attack one side, right? So here comes the freight train trend. You see it coming from a long way away. You see that big headlight coming closer and closer. There's nothing you feel you can do about it. The common reaction as humans is to stick our head in the sand and just hope it goes away, which is not what you want to do. So an active defense allows you to kind of get out of the way of the trade. It does require skill to know when to hang in there versus knowing when to bail out. So I found that the best hedge is one that's placed with a very good reward to risk. It's inexpensive, won't cost you much if the hedge ends up being unnecessary. A lot of people like to talk about hedges. This is what I typically will do, is set up, like I'll set up, if the market's like trending like crazy to the upside, I'll set up something before I need it to the downside. So I'll wait for exhaustion to hit, and unsustainable, or especially if the market's going just straight upwards like this, that's the point when nobody else is doing that, when I will start to add downside hedge trades. So one last thought on defending a trade. Don't use technical analysis to defend a trade. Only make exit decisions by the numbers. I had to learn this the hard way. Okay, so let's go through a weekly income system. I'm going to go through this really quickly here. So we're going to trade SPX options, or you can trade spiders if you have a smaller account. We're going to look to add positions every day, 5 trading days out in time. You can go with smaller accounts, maybe $10 wide spreads, or if you have a larger account, you can do 25 wide spreads. And for the smaller accounts, we're going to be looking for a 25-cent credit per vertical spread, so 50-cent total, or 40 cents a side, so 80 cents total, times 2 per iron condor. Sometimes we will only do one side if the trend is particularly strong. We're going to seek a 2% return on risk per trade, and immediately we're going to set up a 10-cent exit. So avoid entry just before big economic announcements. Avoid entry or go with lower risk entries on days where the market energy is very, very high. Now let's talk about defense. As soon as we set up our trade, we're going to be looking for our defense. So either price threshold, delta, or debit threshold on each vertical spread. Prices in a longer term downtrend, seek counter trend rallies to buy out of the money. Put debit spreads as proactive trend hedge. If market transitions to primary uptrends, seek entries for out of the money call debit spreads. I don't roll or try to adjust the trade. There's too little time in 5 days, too much gamma risk. 252 opportunities a year. Okay. The thing that's really important is that we do a lot of data tracking. We capture the numbers behind every trade so that we understand what's working, what's not working, and if we need to make any adjustments. Let me show you a couple of examples. So here's some recent examples. Here's the entry point for this trade. So here's the price, and we're setting up way down here. So we're setting up vertical spreads with a short strike down here at 40 or 3,900. And we're almost up at 4,300, which is not even on the scale here. So we're just setting up a huge iron condor and getting 80 cents of credit on the entire trade. And then wouldn't you know it, they're both gone the next day. This is very, very typical. So again, we're looking for 2% return on risk. And we just do this day after day after day. It's very simple. And a lot of the intraday price movement, if we get volatile price movement intraday, this is where we can start to close things very, very quickly. Now, some of the other trades that we've been put on, and this has been by our customer demand saying, hey, I'm not comfortable with the risk of these high probability trades. Can you do something with a better risk reward to them? And this is the low probability strategy. So here's one that we entered, earlier this week, right? So 221 earlier this week. The price is coming down to what I felt was a very strong level of support. I didn't expect it to immediately bounce higher nor cut through there. So I thought it would get stuck there for at least a couple of days, and that's typically all we're looking for. So notice the difference here. We're entering the entire iron condor for a much higher credit with a low probability. And it was out at, again, we're looking for about a 10% return on these trades, out the next day for a 10% return. Max risk on Black Swan would have been $245, period. So if we wake up tomorrow morning and the futures are down, 20%, the circuit breakers are firing, and all panic is going on, just like 2020 again, then these trades are great because you don't lose any sleep on them. Okay, performance for these since the service inception. So we started this back in June. Win rate is about 88% on these trades. We're running better than a 1.5 profit factor, which means for every dollar we lose through trades, which is going to happen, we win $1.50. So that's a machine that you keep feeding money into. As long as we maintain profit factor greater than 1.5, this prints money. And these numbers have been achieved during some of the toughest tape in the last 20 years. Nasty bear. Okay, so let's walk through summary and next steps here. And if you have any questions, now is the time to put them into the room. And Rob can help me grab some of these. So nothing I've talked about in this presentation is new, right? So this has been around for a while. Traders have been selling iron condors on the S&P 500 for decades. So why is it that so few are profitable? Perhaps they lack the discipline. Perhaps they don't have a system. More than likely, they'll lose confidence and give up after the first loss. This is why we see traders just sort of bounce from one thing to another thing to another thing, right? And they become a jack of all trades and a master of none. Is that what's happening to you? So confidence must begin by gaining knowledge and then applying that knowledge to learn to win. You have to learn to think differently. You can't take the same skills that work for you in your office career or your construction job and then apply them towards the market. You'll find that you have to learn to think differently about risk. And it helps if you pick one thing, keep it simple, and then keep doing it again and again and again. If you need one piece of this puzzle, or maybe several pieces, then consider joining me at the 12-minute trading daily target 100 service. So we meet every day as a team in a live trading room. We meet at 11 o'clock a.m. Eastern time. So the reason why we meet a little bit after the market open is we let the volatility play out. A lot of times, if it's a big trend day, we're going to get most of that movement in the first 90 minutes. So we let that play out. We see what we want to do, see if we want to trade that day. We work as a team together every day in a live trading room. So we enter trades every single day to give you reps in the system. If conditions do not warrant a real entry, I'll enter it in sim. All live trades are posted in the class portal. We have email, we have SMS, we do it right live in the room, and are backed up by a live tracker. So people always know what I'm holding. So even if you can't attend to the room, you can always watch it later on as well too. But you'll get the trade sent to you if you don't have the time. So these are some of the resources that we have as part of this is a typical trade update, what they look like. Here's the text messages that come out. So we try to over communicate everything that we do. And we do everything through a course format as well too, so that everybody's got a similar level of knowledge. So each day in the trading room, we do a full read on the market, valuation of current inventory, and what we're doing with current positions, plus new trade entries, which are entered live in the room. Every day is like a live coaching session with me. So today's webinar special, no bones about it, 2 weeks of free trial. You get 2 weeks to kick the tires with me to see if this is worth your time. See if you can learn something, see if you can take this strategy. So if you're having trouble putting the pieces together, maybe you need a little bit of help. Everybody does. I sure did when I started this thing. You go to 12minutetrading.com/T100TC. Rob, if you could put that link into the room, I would very much appreciate it. Thank you. So
I'm a step ahead of you.
all right. So spend 2 weeks with me live. If it works for you, it's only $147 a month to stay. You can make that up in a couple of trades. Cancel anytime with no hassle. We're here to help. 12minutetrading.com/target100TC for Trader's Corner, T100TC. So please don't miss out on the free trials. They're going to be taken down as we get into next week. No risk to try it out. Kick the tires for 2 weeks. Join me. If you have any questions, you can always email me as well to doc@12minutetrading.com. And with that, Mr. Rob, I have completed my material. I'll see if there's any questions out there, but if you want to, you can just stay on schedule and transfer over to the next presenter.
Just because I have the question list up, the two that seem to be most prominent were the recommended account size.
Recommended account size, you can start this with, it's something as low as like $1,000 if you want to trade these on the spiders. If you're going to trade these on the full S&P, I would probably go at least 5,000 just on a margin basis.
Another was how much are you collecting per iron condor on the wider?
On the wider, it's $80 per iron condor on the 25 wides. These are way out of the money. These are way out of the money ones. The ones that I like better in today's market is the one where I'm collecting the full 250 on a $5 spread. So $250 collected on a $5 wide iron condor.
That's an awesome risk, risk return ratio for the probability that you're getting with it. A few people too asked about the options level, which off the top of my head would be level 2.
Level 2, level 3, something like that.
All right.
So it's just standard spreads.
And are you available on NinjaTrader?
That I don't know.
I believe NinjaTrader will do it because it's kind of, a third-party GUI platform that, connects to a brokerage and offers additional feature.
I currently use them through Tastyworks, Thinkorswim, and E-Trade. So those are the 3 live brokers that I do every day.
No, I know NinjaTrader does connect to TD Ameritrade or Thinkorswim because it's what I use. How often do you give out low probability trades?
Every day. So we're either doing a live or sim, depending on whether the market supports it.
All right, and that'll about conclude what's been appropriate with questions and that I didn't pick up were already answered. Doc, I want to thank you for being here, all the great information and the great strategy. I love the simplicity and a 95% win rate, and the ability to learn the system in less than a minute. Thank you so much for sharing this with our audience. And thank you so much for making them an offer that they can't even refuse. If anyone has an interest, they've got some free time with you to decide if it's for them or not. Ladies and gentlemen,
everybody.